Greetings and welcome to another Meet Kevin report. Today is episode 107. We have the Consumer Sentiment Survey coming out today from the University of Michigan. That's going to be a big deal, mostly because we're going to look to see if consumers' inflation expectations are indeed remaining anchored. So we'll find that out in about 6.5 minutes. So stay tuned for the Consumer Sentiment. Actually, hold on. Is it a 5:30 release or is it a 7 a.m. release? It might be a 7 a.m. release. So stay tuned. We might hear that a little later, but I'll find out in about the next 2 minutes. Then we're going to, so that'll come out today. That'll be somewhat of a big deal if it shows any kind of unanchoring. It won't be a big deal at all if it shows signs of anchoring. We did have Mr. Waller from the Fed come out today suggesting that, hey, look, the banking crisis was something that affected smaller and regional banks, but it's not something that should change Fed policy, mostly because the credit tightening that has happened after the bank failures was really consistent with the credit tightening that was already happening because of higher rates. So we don't really think the banking crisis that affected some smaller firms really affects the entire financial system to the point where the Fed needs to change their interest rate policy. So that's a little bit of a hint that probably hinting towards one more hike. And that's basically what so far a lot of the Fed governors have been pointing to. Hey, two might be a lot, but yeah, maybe there's one more. We do have the sentiment surveys actually coming out at 7 a.m. So keep that in mind. That's during course member live stream time. But that sentiment survey comes out. The expectation is sentiment's going to come in at 60, 65.1 for current conditions. 1 year out inflation expectations are expected to come in at 4.1%. That's down from 4.2 the last, and the 5 to 10 years expected to come in at 3%. Now, remember, these inflation expectations are important because they're part of what the what the Federal Reserve uses to calculate what rates should be today. Now, that's important, and I think a lot of people forget that. For example, yesterday Elon Musk replied to a tweet suggesting Jerome Powell will not lower rates for 2 years, and that is not what he said. In fact, I replied to that chain. It's right here. It says, "Good morning, everyone. Jerome Powell said the Fed's forecasts have been wrong on inflation in the last 2 years." And he actually said economists' forecasts have been wrong the last 2 years. But anyway, now he's saying rate cuts aren't going to happen for another couple of years. That's not what he said. He was responding to a 2 year projection statement. Elon replies here, he is wrong. I thought it was interesting. I gave this reply here. I broke down the formula again for those on Twitter, which is probably a little too complicated for the Twitter world. Twitter world seems to like, is it going up or is it going down? As soon as it gets complicated, people don't like it as much. But anyway, I provided it anyway. And we know this, right? Jerome Powell's formula for reducing rates, which is actually what he reiterated, is cut as inflation expectations fall. Expectation plus the target real rate equals the nominal rate. In other words, we get to the 5% when you add together 3% plus the target rate. That's how you get to some sort of inflation adjusted rate where we sit now to have sufficiently restrictive policy. And when this number 3 falls is when we expect to cut. We actually, if you look at the 5-year break even, we haven't gotten to that cut level yet. We've talked about this, golly, probably for at least a year now, but we've talked about the 5-year break even as being this tool that'll indicate when the Federal Reserve is likely to cut based on when the Federal Reserve cut the last time in the last cycle, ignoring COVID. And so when was that? You go back 5 years and you go to 2018. And when you go to the 2018 cycle, you can see what level we have to be at on the 5-year break even to, in my opinion, expect a rate cut from the Fed this cycle or this time around. So in other words, we can actually rely on history as potentially a leading indicator for when the Fed is going to cut. And that's provided by this chart right here on screen. Oops, I made it hide. Hold on one sec. There we go. This chart. Okay, cool. So let's manipulate this chart a little bit. And I think this is very important. Now, as I mentioned this chart, I want to remind you that phase 1 of that coupon expires today. Remember, there are going to be 4 phases of price increases. The first one on screen now starts tonight. And that's because we're getting ready for a massive new release of a bunch of new lectures and various different programs. Remember, we've got Zero to Millionaire Real Estate Investing, Stocks and Psych, Property Management, and then on the income side, we have the getting SH90 done faster with AI, real estate sales, and building wealth with YouTube. So take a look at those linked down below. First phase expires today. But take a look now at this chart. This chart gives you your guidance for exactly when the Federal Reserve will cut. And I think people really forget this. But that's okay. If we know about it and other people don't, then it gives you alpha, right? It gives you market insight that other people don't. And one of the reasons I've been going long the market, certainly since the probably around mostly been along the market since about the middle of last year, and really heavy into then chips and tech starting in about November. But if you take a look at this, this really gives you your guide of okay, well, as long as we're trending down on these, the rate cuts will come rather than a Paul Volcker. In order to get a Paul Volcker, you need inflation expectations to do this, which is what they had done during 2021. This is why going into March of 2022, everybody feared Paul Volcker so much and we saw such lows in the market because the fear was if these expectations continue on forever, we're screwed. But the opposite happened, right? Expectations fell. Now, what level do they need to fall to see cuts? Well, let's first mark the next or the last time the Federal Reserve has cut. And the last time the Federal Reserve cut was, well, over here during COVID, right? This was our emergency Sunday two rate cut. And you could see this occurred right around the time the inflation expectations were over here in a pit. But we're not going to look at this. This is really when COVID started, and over here is when you had the Fed rate cuts and unlimited bailouts, and all of that happened over here in the mess. Let's ignore that for a moment. And let's go over to the last time we had some sort of pivot from the Fed, which was really the end of 2018. And so your pivot was really about here. Let me see if I can get that to be exactly perfect for you. Give me one sec. I'm just going to look at the data. I'm looking for, okay, there it is. It looks like it was about 1.70. Let me put that on screen for you here, because in the back end, I can actually see, when I hover over, I can see what date these are. But anyway, it was about 170. So yeah, right about where I had it seems to be about right. So 170 is right about where the Fed last sort of pivoted. 170 is right about here. There you go. And so you can see where we are now. Where we are right now leaves over here at 2.2, leaves a little bit of work to do. In fact, it leaves about 50 basis points of work to do. 50 basis points is about the difference between what we see now and what we saw during the banking crisis. About a 50 basis point difference over here. It's also this difference that we saw if you ignore sort of the March crisis here and you go back and say, well, how about from today back to when did we have 50 basis points? Well, it was actually in September. That's about 9 months. 9 months is quite a while. If we continue at that pace, it would take roughly 9 months for the Fed to get to that cut level. 9 months would be consistent, actually, though, and it's kind of creepy, but when you align it, a 9 month decline in inflation expectations would align with March of 2024, Q1, which how interesting. Q1 2024 is actually where a lot of people right now are placing their bets for Federal Reserve rate cuts. And that's probably where we're going to see the rate cuts, whether it's January or March of 2024. It'll probably be punted to then. Much like recession expectations are being punted to 2024. Currently, you have about a 34.7% chance of being at your first rate cut by March of 2024. But if you actually add in the odds of those people who think you'll already be on your second rate cut, 14.6%, and your third rate cut, 2.2%, you're at about a 50.1% or 50.1, sorry, 51.5% chance of rate cuts by March of 2024 based on what the market is pricing in now. Whereas most of the market, and when I say most of the market, I can give you the exact math on that. Most of the market is actually 75.6% thinks we will still not have cut rates by January of 2024. Now that's actually good. That shouldn't discourage anyone or make anyone sad. The reason for that is because it means the market has already priced in that we're not seeing cuts really until the coin toss potential. So let's write that down clearly here so we can all see that. So we have a coin toss potential of cuts by March 2024, which is consistent with this chart that we just explained, which suggests that we have about 9 months to go. Now, this is a pretty bumpy chart, and the volatility will suggest that we may get there faster or we may get there slower. But I believe that this is really the tool the Federal Reserve is using in the background to guide their decisions. I believe this because if there was one thing that screwed up the Federal Reserve in the 1970s, it was failing to respect this chart. This chart failed the Fed in the 70s because they ignored it. Had they paid attention to this chart in the 70s, they would have undertaken the correct interest rate policy much earlier. But they didn't pay attention to this chart until about 1981. Now, that's remarkable because in 1981, you can go back through the historical archives of the exact transcripts, not even the minutes of what they said at the meeting, but the exact transcript. And you can look at the transcript of what the Federal Reserve said. And in 1981, the Federal Reserve all of a sudden realized they had screwed to maintain inflation expectations. They screwed up. And in order to actually control inflation again, they needed to lower inflation expectations by aggressively raising rates. And that's ultimately what became Paul Volcker. So Paul Volcker came about by raising rates aggressively, realizing they had not killed inflation expectations yet because they raised rates aggressively in 1980, but they didn't go far enough to get that chart to come down. So even though they cut rates stupidly too early in 81, they ended up having to hike rates substantially again starting in late 81 and through 82, causing this near 20% interest rate fight versus a near 20% or 20% near 20% inflation rate, near 20% Fed funds rate, just to crush inflation and create a nasty recession. That was the definition of getting Paul Volcker. And it all resorts back to one chart. And that was anticlimactic. There we go. That chart. And this chart, if there's one thing you want to look at on your trading view on almost a daily basis, it's the 5-year break-even chart. You could just type that in, 5-year break-even. It's the difference between the tips and the 5-year treasury bond. So there's a lot of volatility since it basically moves every single day. But you can see this on TradingView as well, or really wherever you want to look. But I would encourage watching this. And when this level gets down to about 1.7, which I think will be somewhere around March of 2024, I expect the Fed to pay attention to this chart and cut rates. But you can see we're not there. Are we potentially consistent with a pause? Only to the extent that this does not keep rising. I think you can actually indicate or use this as a tool to suggest whether or not the Fed will hike or not in July. I think that if in July, we are still range bound. So let's consider that for a moment. The Fed, let's say it's the day before the Fed meeting in July. And let's say that the inflation expectation level has been bounded between this range right here. I think the Federal Reserve might be convinced to hike rates again because they need to drive these expectations down again. They need to get this to come under this to slowly start trending to 1.7. And if they aren't seeing this level come down, they might need to hike again. Now, if by the time we have the next meeting over the next, let's say, or call it over the 3 weeks before the meeting. So in other words, within the next couple of weeks starting, and then over the next 3 weeks thereafter, which would be the 3 weeks before the meeting, since the meeting's about 4.5, 5 weeks away. If all of a sudden inflation expectations are trending down and they're within this range, we're at about a 2 or a 1.9 for inflation expectations. I believe it would make sense for the Federal Reserve to say, hey, look, we're going to wait until September. Or they might say, we're just going to skip another meeting, whatever, right? That would make logical sense based on this chart. So far, this chart has guided all of the Fed action. And we don't need to go through the history of it because, we know practically it has worked. But I mean, you could consider this by looking at, look, it's really high. Let's get 75 basis point hikes. Okay, it's moderating. Let's go 50 BP hikes. Okay, it's moderating even more. Ignore the banking crisis for a moment. It's moderating even more. Let's go with 25 basis point hikes. Okay, it's pretty stable. Let's go with a pause. Okay, if it stops or it unanchors, oh, let's hike again. What's it going to take to get down to that ding rate cut? So we'll see. But I believe this is a very fascinating tool that really everybody can use. And quite frankly, many analysts, I think, are under analyzing and underusing. But that's okay. I think when other people aren't using those sort of tools, they give you an edge in the market. Finding those sorts of edges or things that we do on a daily basis, whether it's in a real estate investing chat or our stocks and psychology of money chat or productivity chats that we have every day the market is open in the courses linked down below, where we're going through earnings calls, we're going through reports together, we're doing fundamental analysis. So remember to check that out via the link down below, because we've got a pricing increase happening tonight. Okay, so now let's move on to some of the other topics here. So that was a good little 15-minute segment here. Let's get into some other commentary. We'll also see what the good old CNBC folks are up to in a moment. But first, actually, I'd like to focus on OPEX. So today is OPEX, which is options expirations day. You've got about 4.2 trillions in quad witching here of expirations and potential volatility. I'll tell you, historically, witching days, like they seem to be more positive than negative if you go back and look at them. They don't seem to be that bearish of an event. I think they do create some substantial clickbait and make for great headlines and make for great commentary and drama. But I mean, if somebody is a bear right now and they're citing witching as a fear of theirs, I think they've run out of bearish things to talk about. It sucks for them, but this market is much closer to euphoria than it is closer to fear over witching. And I think you can easily evidence that by looking at an IPO like Cava. Okay, this is a restaurant group that started out by making hummus and stuff. They have net negative income. They're losing money. They are net negative free cash flow by about 24 million bucks a quarter. They have net negative income. The only way they go positive is if you add back in depreciation, for their plant property and equipment, and then they go positive. But still, they've just gone from 1.6 million shares outstanding to somewhere closer to 15, 16, 17 million shares outstanding, thanks to their IPO. And yet, from IPO price, this was set up to double on a negative cash flow, money losing restaurant business. To me, this is the perfect signal that the bears are maybe correct with some fears that there's euphoria or things shouldn't be working like this, but they're wrong from the point of view of positioning. And I think that's the big thing that bears are missing right now. I'm going to say this word or this phrase, and I want you to think about this today. Like, I would write this down. There are no sellers left in some of the small stocks. There are no sellers left. Look at a Nikola, for example. There are no sellers left. The people who have held this stock to 50 cents are in it to the end. The stock that memed up to 50 bucks or whatever, during here, I have to go out to the week chart to see it. This is so dramatic. Oh gosh, the week chart doesn't even do it for us. Let's go to the month chart. Oh, jeez. There you go. The people who have diamond handed this from SPAC days of $10 to nearly $100 down to 50 cents are in it to win it. And they're not selling anymore. The slow bleed in this environment has ended. So it doesn't matter what the stock is. You could look at these companies and potentially evaluate short interest, which we can go through and evaluate some short interest in just a moment as well. But you have to ask yourself, are there really sellers left at some of these companies? And if there aren't, then it doesn't take many buyers to actually get a pretty remarkable upswing in these stocks. The same thing is what you could ask yourself for Carvana. Are there sellers left at $3? And then it just takes a little bit of buying and these things go euphoric. You might see Matterport actually do the same thing. Are there really sellers left at $3? I don't know. Weeble's indicating a buy side imbalance, but you haven't started seeing that sort of meme run over there. You actually saw some kind of meme momentum run at Dave and Buster's, even though it's kind of been stuck in this wedge pattern over here. Let's go down to the day chart. And you can see more recently here this explosiveness. And it's really because are there sellers left at 31? Well, now we're sell side imbalance because we're breaking out of this wedge, but and different from the real estate wedge, by the way. But anyway, technical analysis wedge. But anyway, over here, you don't have sellers left. And so when you think about that from a market positioning point of view, it makes sense why funds are probably quite mispositioned right now, and you're getting a lot of this rallying. Remember when we looked through the Bank of America Fund Manager Survey, what we noticed is that even though institutions were becoming somewhat bullish on equities, they were still vastly mispositioned. The fund manager survey from Bank of America indicated that most fund managers were 32% underweight the stock market, which is really a sign that a lot of money is potentially still on the sidelines that could race into markets and actually prop up a lot of these stocks, whether it's simply through throwing money into indices or it's simply because people realize they're mispositioned and so they're allocating to to various different stocks that have sort of been left behind, right? But let's look at some short interest here. Let's look at Nikola. Nikola's short interest right now as a percentage of float, 21.6%. Tesla as a percentage of float isn't actually that high. As a percentage of float on Tesla, it's about 3.4%, but the nominal value is pretty remarkable. The nominal value is $23.5 billion. It's actually been going up over the last few days. It went up from about $22 billion. Dave & Buster's about 11.2% short, and it started declining, indicative of a short squeeze that you've had in the last few days at Dave & Buster's. Something like Salesforce or Nvidia are very little short, only about 1 to 1.1% short, mostly probably because of the AI rally. It's very difficult to be short in those sort of positions, right? If you look at let's go with what's another one we can go with? You go with your classics, your GameStop. You're about 21.8% short right now. Look at a PayPal, another one that's kind of been sitting at the bottom of the barrel. Is only about 1.94% short. So hard to really call for a squeeze there. Whereas you look at something like SoFi, its short interest has fallen from about 14.5% down to about 13. So you are getting some degree of squeezes. And these are all important things to consider. I don't necessarily think buying and holding the squeeze stocks makes sense from a fundamental point of view, but there is some technical short-term playing that can be done on some of these stocks. And I think there's money to be made. It's just important not to diamond hand some of the squeeze stocks. So, when you make money and you start seeing the turn, maybe it's time to take some profits. Obviously, ultimately, that's up to you personally. But I mean, you know, usually you see stuff like that when you start getting red. So let's go to, for example, a SoFi. Who knows? But what did you have yesterday? Yesterday, you had your first red day, 1.95%. Today, in the pre-market, you're down about 5.4. The question is this, was this a fundamentally driven rally or was it a short squeeze? We see the short interest position come down. It's still 13% short. And so that'll be something that I think individual traders will have to evaluate. But it is an interesting environment that we're in, considering that you can have a lot of these stocks that rally because they have high short interest, and bears might look at this and go, "This is ridiculous. This is euphoric." But what I do is I look at that and say, "Hey, the more euphoric." An IPO of a money losing company, I don't care if they have the best food in the world. I care about their financials. If something like this can IPO so strongly, in fact, I made this joke yesterday. I go, fundamentally, I'm not touching this thing, but I hope it moons. I said that quote yesterday. I said, I hope it moons. And you know why I hope it moons? Because the more euphoric the no fundamental stocks go, and the more ridiculous the no fundamental stocks rally, the more support you actually have for companies with real fundamentals. And I'm not suggesting that 433 is absolutely supported at NVIDIA, but there are really good fundamentals at NVIDIA, at AMD. Intel has phenomenal fundamentals, but people have kind of forgotten about Intel. I think if people wake up and realize the foundry investments they're making, they're going to see this as a sleeping giant, or it's a value trap and it'll go bankrupt. It's probably either of those extremes for Intel. But it makes the fundamentals for Tesla look better. It makes the fundamentals for Ubiquity, which is another one that's just starting a rebound, by the way. This one's a very low float stock. There's not a lot of uh, pricing action on a daily basis. So that does create the potential for violent swings up or down. But it is on this nice little U shape up now on the day chart. And you could see previously, you really bounced a lot around the $300 level. We're about a double away from where it sat for 2 years at the $300 level. And it just only recently in April in April and May had its recessionary fears come in. So I think that's a great one for fundamental point considerations. And again, the more meme-ish things get, the more the good companies with fundamentals I think have support. Etsy is another one that I think has decent fundamentals, and as well as Enphase, and those are still relatively low. You look at something like Embraer, even. Here's another one. Decent fundamentals, starting to get a little rich, but something to keep an eye on. But anyway, again, so the more these smaller things rally and go euphoric, I think the better for the companies with the real fundamentals. So when I go over to the pre-market charts, and I see, Virgin Galactic 43%, Nikola 17%, Lordstown Motors 10%, Smile Direct 6%. Oh, here's Canoe. It's happening to Canoe 17% yesterday and 6% today. Or Arrival. Oh, we're going to do micro factories because we can scale those better. Okay. Or Workhorse. Darn, we went to crap when we lost the UPS contract. Sorry, the USPS contract. Well, when these stocks are going 9% yesterday, 5% today, I don't look at that with FOMO because I don't want to hold those. I look at those and go, thank you for showing me that there's plenty of euphoric money on the sidelines willing to pump these things up. And the more these things pump, the more my stocks with real fundamentals have actual foundations that start getting built under them. Because then people make money over here and they slowly trickle them out of these and reposition those to real fundamental companies. And it also gives more of your fund analysts this feeling of like, all right, well, if everything's gone up, I guess it's hard to be bearish. Now that's not necessarily good evidence to say, oh yeah, you're definitely in a sustainable bull market. If anything, to some extent, these smaller stocks rather are at risk of a large collapse again in a recessionary environment. There's a lot of risk in holding them. You could play them to trade. I don't think it's a good idea to hold them, and I don't think anybody really is looking at the smaller companies here that have had extreme hardships, your 95, 99% declines. I don't think most people are looking at those as super strong fundamental plays. The exception of maybe SoFi. SoFi's got a good mix of both, I think. They do have strong fundamentals. Maybe not necessarily support this price, but they've got a combination of meme-ish and fundamentals. So they've got a little bit of both. They got a good mix. But anyway, point is, this is indicative of a more bullish and oh no, we've been left behind market. And it shows you when people have misallocated too much money to cash or treasury bonds or whatever, they feel like they have to jump into the market. And that's what you're really seeing evidence of now. And so to me, that's just an example of really what you saw in like, to me, it puts you around like the summer of 2020. I don't think it puts us into the insane world of 2021. Not there yet. Although we might be getting there with how we're trading on like the S. Look at the S&P's recovery here. I mean, we're at like the 78-ish percent Fibonacci retracement line here, all the way back to all-time highs. But for me, the market feels like we're somewhat in a mid 2020. I think if we really break out here and start hitting all-time new highs again, above and beyond what we saw in 2021, yeah, that's probably when it starts looking a little bit too euphoric again, where you start asking yourself, okay, when is it time to start trimming? You could do the same thing at Tesla, for example. But Tesla's what, at just above its 50% Fibby over here. I mean, are we? Let's see. Right now we're at 257. Yeah. So here's a stock that still has room before it gets to really euphoric levels. I mean, really euphoric levels were probably this 414 level over here. That aligns with your peak in November of 2021. Of course, you had some volatility over here before we had the larger declines. But yeah, I mean, there's clearly still room here, as with, again, some of the other companies we look at that are still trading at the lower end. once all of these start breaking all-time highs again, that's when you know you're really in a broad-based euphoric market, and maybe that's a signal to start trimming. But with so many companies still being left behind, I don't think we're there yet. But again, seeing the meme movement is indicative of me, or to me, of people going, okay, yeah, we were mispositioned. Let's reallocate. My thesis. So we'll see how that plays out. Oh, by the way, have I reminded you that there's a price increase on the programs on Building Your Wealth tonight? It's equivalent of about a month free if you buy today before the expiration. If you end up using BNPL, all of the courses are eventually getting new lectures here, but the next focus right now, after this 4 phases of price increases, is going to be the zero to mill real estate, stocks and psych, and the AI getting SH90 done faster and productivity course, making more money. Those are going to be getting large new lecture sets after the end of the 4 phases. So we're pretty excited about that. Okay, cool. So let's call that. I'll just label that meme for right now. Okay, cool. So now let's jump into. I have another piece from B of A Bear, and it was actually pretty good. I want to take a look at that B of A Bear piece. And the Bear, a Very Little Brain. Interesting title. Anyway, we're going to pull this one up. Not only are we going to look at this one, though, we're going to look at a flip-flop from another Bank of America analyst last week. And I really like this one, too. I want to say they called this one Bye Bye Bear. Let me see if I can find it. It'll just take me a second here. Bye Bye Bear. Oh, got it. Yeah, it was a Bank of America piece. Okay, so we're going to put together these two pieces, and we'll look at them together because they're quite fascinating. And we'll have a lot of charts and data and insights. Let's do a really quick check, though, of the pre-market right now. It looks like you've got green down by 13 bips, 25 bips on the S&P, 38 bips on the NASDAQ. Bond side, you're sitting at 2.2 bips, so about 3.75 on the 10-year. Still aggressively high. I think before we talk about the B of A thing, there's actually a potentially an argument to be made for doing some brief commentary on rates. Let's do that for a moment. Yeah. Okay, let's jump into that for a moment. So we're going to do some rate commentary. And then I want to jump into, here it is. Oh, I replied to him. Where is the darn thing? At least I thought I did. Whatever. I'll find out where it is. Okay, so let's jump into rate commentary. So starting with rate, what's this? I'm using AI to help me create a startup. Thanks to Kevin. Alan, that's amazing. That's a nice pitch. Thank you for that. Hey, well, it's the perfect time to remind everyone. Price increase tonight on the courses of building your wealth. All right, let's talk rates. So here's the thing about rates. Ross Gerber mentioned something yesterday I thought was very interesting. He said interest rates for real estate may actually be substantially high for quite a while, and that we might not see this return to the 3% mortgage for quite a while. And I wanted to add some commentary about this and align this with what expectations we have for the Federal Reserve. But let's start by just looking at some of the parts of this. So right here, Ross Gerber says, first of all, you're beautiful. Then after that, he says, rally, rally, as the new bull market gores more bears. Rally is saying no recession, and Fed is done. Fed knows that higher rates will only kill more banks. You could see it in Powell's face. Ooh. But anyway, the truth is, we won't be seeing 3% mortgages again for some time, maybe ever. And that loans that back American banks are forever impaired. As loans mature, the new loans will have twice the interest rate, which will be a drag on the US economy for at least 5 years. Basically, most commercial real estate and the loans that banks will never return to values implied when rates were zero. It's a shell game now on who owns all of the debt, basically. But the write-downs haven't even really begun, and he's suggesting this because technically, as long as you're holding to maturity, you don't need to write down these losses on these bonds. But as you hold these 1 year, 2 year, 3 year, 5 year notes to maturity, and they roll over, yeah, you'll have a higher interest, either expense for your debt, or your assets will be worth less potentially via inflation, and now you have to reallocate. So it's interesting. If you do end up holding all the way to maturity, though, you technically don't have to write down other than inflation. So it is somewhat interesting to see what losses some banks will end up seeing here. But I think a commentary that I want to address is really this. The truth is, we won't be seeing 3% mortgages again for some time. So I want to think about that for a moment. So, first of all, we got to zero when the Federal Reserve really dropped, rates to zero on a Sunday during COVID, and that's really what dragged mortgage rates down to you're about 2.7-ish% over time. I do believe that in the next decade, we'll probably be back at negative interest rates, which I know sounds remarkable to think about right now, but I'm saying somewhere between now and 2020 or 2033-ish. Ooh, that's weird to say. So it'll be absolutely some time before we get back to negative rates. But I think we will trend back to lower rates. However, I agree that the odds of us returning to 3% mortgage rates anytime soon might take a while. I actually think that's why there'll be a really big opportunity to buy properties and real estate cash over really the next couple years. I don't think the real estate market will take off and start skyrocketing again. I think you'll have either a sideways or potentially even downward slipping real estate market slowly and patiently between 2024 or 20 yeah 2024 2025 as we sort of see interest rates adjust or stabilize as we get back to normalization and as we see rental rates and demographics normalize. So to that extent, it's possible that it could be 2026 before we really start seeing meaningful rates that actually drop mortgage rates again, especially as credit spreads could widen to where, as the Fed is actually reducing rates, you could see spreads on mortgages go up, which could actually keep mortgage rates elevated. So, point is, yeah, I don't think there's going to be a rush back to these lower levels, but and I think patience will be rewarded. But I actually think that's a good thing because I think that opens the door to potentially, hey, make as much money as you can now, maybe in the stock market, which is showing signs of euphoria again, though not 2021 levels of euphoria yet. And then build up as much cash as you can so that when it becomes time to buy real estate, maybe that's Q3, Q4, maybe that's all throughout 2024. You're more prepared to go shopping and diversifying back to real estate. That's at least been my plan since the beginning of 2022: is ride stocks first, always recover first, and then dive into real estate. So we'll see. But it's some interesting commentary here from Ross, and we'll see who ends up being right. But Ross goes on to say here, the longer that rates stay high, the more buildings that go under. This is relevant to commercial real estate, right? And he says this is irrelevant to demographic shifts away from, from office buildings and shopping malls. Google even bought a mall in LA and turned it into a new office building, empty. How much do they lose? Oh, this is interesting. So really what he's saying is he's making this argument that, hey, we know we have a crisis in office buildings, but even other buildings that might try to advertise themselves to office buyers, like maybe a shopping mall that has its valuation propped up because of an office comp, may have been a big mistake. Quite interesting. An interesting argument here. Ross goes on to say the Fed knows that under it all, they have created a huge amount of damage by rapidly raising rates, and now they've struck the banking system with at least $1 trillion in losses. Of course, they're not going to recognize their loss on the balance sheet. They call this the tightening of credit conditions, which means the banks are effed. So they can't lend money or more money as they don't have the capital. The truth is, the biggest risk right now might be deflation coming. I think somebody needs to teach Ross how to do threads, like where it's all under one tweet, as opposed to just on your profile. But it still works. It actually worked. So that's, actually might be easier because you don't have that darn nestedness. Okay, I like it. The good news is that when the Fed does lower rates, this will work well to stimulate the economy, hence the market rally. Right. Well, starting to try to price in when the Fed will actually lower rates. Interesting. And here he is talking Tesla and Yahoo Finance. Oh, good old Russ. So anyway, that's awesome. It's an interesting take, and I don't disagree with it. I think it will take quite a while for rates to rotate back down, and that does call for patience. So we'll see what happens there. Keep in mind, again, price increase tonight, and that'll be phase one of the four-part price increases. All right, let's now jump into that was rate commentary, so let's call that rate commentary. Forte rate commentary done, and then now I want to get into the bear pieces. So let's look at the bear pieces. All right, stand by 1 second. Stand by for the iPod. Extra camera. And this camera. Oh, hold on a second. Is it there? Oh, it is coming. It is coming very slowly. It will be coming very shortly. There it is. It came. All right, here we go. Good, perfect. All right. Now we're going to cover two bear pieces, or bears who used to be bears, and we'll see what kind of commentary they have from Bank of America. Now there are two pieces. There's one called Bye Bye Bear, and then there's another one that analyzes the potential trajectory of our market into recession and three potential outcomes. The first that I'd like to start with is Bye Bye Bear. It's actually from last week, but it's worth still covering. And then the other one is just from today. So the other one is super fresh. So we'll get through two of them. One that's a little bit older and one that's super, super fresh. So let's start with this one. This one right here is called Bye Bye Bear. And this used to be a very bearish analyst. And they've just had a change in tone. Let me go ahead and throw up my little banner here for that coupon expiring tonight. There we go. Okay, good. So the new bull market has legs, says this analyst. The bear market is officially over. Now remember, we had a warning from Cameron Cruz over at Bloomberg that just because markets have risen by 20% is not a signal that technically we are out of the woods in terms of potential downside going forward, given that during the dot-com bubble, we had three escapes via a 20% end to the bear market, and we still had downward pain ahead of us. Anyway, we don't put a lot of stock, pun intended, into arbitrary definitions. Okay, good. But note that after crossing the 20% mark from the bottom, the S&P 500 continued to rise over the next 12 months, 92% of the time, versus 75% overall. So just ignore the 2000s era, which would be that 8% of the time. Returning on average 19% versus 9% on average earlier, dating all the way back to the 1950s. So when you basically extract the dot-com bubble, coming out of a bear market with a 20% rally in the S&P 500 is historically more likely to be good than bad. In fact, 92% of the time, the market goes up like 19% more thereafter. That's good. That's bullish. Sentiment, positioning, fundamentals, and supply and demand support that. Being underinvested in stocks and cyclicals is a key risk today. Wow. Savita was always a big bear, and she flipped. She flipped into now saying, well, the bigger risk today is being underexposed to stocks. This is what I've been talking about for like 9 months. That people are like, Kevin, when are you going to buy crypto? I go, the biggest risk right now is being underexposed to stocks with real fundamentals. Here we are 9 months later and a massive rally later, and now the analysts are finally waking up. Let's go. Okay. The more likely direction of surprise is still positive. We here provide our views on the most asked questions from advisors and clients. Quote or question. Oh, sorry. My short shorts pulled the HDMI cable out. My bad. Or am I wearing short shorts? Maybe I'm naked today. Anyway, what will it take to get investors bullish again? The official end of the bear market might help, but the wall of worry could continue until investors feel pain in long bonds or FOMO. Ooh, that's actually a really interesting argument. This first one here, pain in long bonds. Now that I find interesting. Let's see, pain in long bonds. When are you going to feel pain in long bonds? Well, for you to feel pain in long bonds, you'd really have to see yields go up, because that would make your prices go down for bonds that you're holding. How else could you feel pain? Well, I think you could also feel pain in long bonds by realizing that maybe your bonds are stable. So let's take a look at this. Sure, bonds could feel pain, like price could go down as yields go up, but we don't necessarily think that yields are going to go up. What if yields just stay flat? Well, if yields stay flat, then the value of your bonds stays flat. And if at the same time the stock market is going to do this, I think what she's actually saying is it would be a combination. Like your long bonds and your portfolio is flat and everybody in stocks is running away. That'd be a little bit of a pisser, right? But anyway, AI and more below. But a broader bull case for stocks can be made. We are off zero interest rate policies, and real yields are positive again. Volatility and rates around inflation have subsided. No longer afraid of inflation. I'm not afraid. Anyway, estimate dispersion, as in earnings uncertainty, has declined, and companies have preserved margins by cutting costs and focusing on efficiency. Even Adobe today revising up their guidance, leading Adobe to actually rally in the pre-market here as another software stock set to benefit from artificial intelligence. After a fast hiking cycle, the Fed has latitude to ease. The equity risk premium could fall more from here. Notice she italicized fall. That's because a lot of people are really frustrated that the equity risk premium is already relatively low. People are like, it should be much higher. That's actually an argument that the bears are making. Show shorts, show the shorts, and I'll sub. You'd have to watch my OnlyFans for that. You'd have to pay for that. Come pay $4.99 a month, and you'll get that. Anyway, okay. Which equity index, equal weighted or cap index? Okay, so let's get through a little bit more of this. Quick reminder, because I don't think I've said it yet, and I'm only going to throw the banners up really quick. Yes, we have a price increase tonight. Phase 1 of the price increases happens tonight for the courses on building your wealth. Here are all of those courses. You can just pause there if you want to see them. They're amazing, and we're basically adding a ton more lectures, so we're very excited about those. Okay, now, and the first phase of expiration is tonight, so I'll just leave it there. Okay, so which equity, equal weighted or cap weighted index? So anyway, the equal weighted S&P 500 could yield double the returns of the S&P 500 index based on various signals. This includes breadth, revision, value, blah, blah, blah. They're basically saying today the mega caps like the Apple and Microsoft may have already rallied a lot, and it could be the rest of the S&P 500 that rallies more. Remember, like somewhere around 95% of the gains the S&P 500 has shown this year have been driven by like 7 stocks, like, Tesla and Apple and Microsoft and Google and Facebook. Anyway, if stocks are reviled, why is the S&P trading at 20x forward earnings? Okay, so this is a dangerous, I don't actually know that that's forward earnings. I think that might be trailing earnings. So the dangerous thing about using price to earnings ratios in a recession is that price to earnings ratios are calculated by looking at price, oh my gosh, imagine this, over earnings. Well, if you look at the last 12 months, what have earnings done? Oh my gosh, they've been in the gutter. And when the number on the bottom gets smaller, the total number gets bigger. Oh, look at that. It's 5th grade math. Yay. So all the, frankly, idiots looking at trailing 12-month PE ratios don't understand simple math. And that's okay. But when you look at forward earnings, the valuations of a lot of stocks are actually still very reasonable. Etsy, Enphase, your Ubiquity. Tesla's starting to get a little rich again, but it still has legs to go. Anyway, so we'll see. How do I invest in AI? Ah, yes. Oh, well, that would be through Kevin's AI course on productivity, where it's not about what tool to use, but it's about mastering how to be productive with AI in your business or as an employee. Anyway, recent developments in generative AI herald a sea change. The obvious beneficiaries are CapEx takers, the ones I just mentioned, and then you have semis and software companies that can provide AI services, but not all tech wins. Many need to spend to remain competitive. The large benefit may be had by old economy, inefficient companies that can increase their earnings power more permanently from the efficiency and productivity gains. That's an interesting argument that maybe, what companies are actually going to be able to deploy the productive AI rather than the software that's maybe providing the AI. I'm very bearish AI software, but I think many of you already know that, mostly because we don't know who the winner is going to be yet. Okay, so here's a chart of various different cycle market bottoms. What will it take to get investors bullish on stocks? We believe we are back in bull territory, which might be part of what it takes to get investors enthusiastic about equities again. This is crazy. Basically, as of a week ago, and in the fund manager survey we just looked at a few days ago, everyone is still under allocated to stocks. And that is great if you are long stocks right now. If investors feel pain in bonds via lower returns or negative opportunity costs, there it is. That's what we explained on the prior page. Real rates rising from here, they should be inclined to return to equities. Right. And then they sell bonds. They actually lower the price of bonds, potentially keeping yields higher. Crazy. Why would real rates rise? A shift from net buying to net selling of the 10-year treasuries. Yep. By foreign buyers or individual holders. Yep. Very, very true. As people move from bonds to cash, you actually drive yields higher. That could mean the stock market could go up as yields go up. That sounds crazy, doesn't it? But anyway, it's possible. Rates, mean revert, lower. Okay, well, it's just some random chart here. Should I index or invest in actively managed funds? We like both, but a choice of index is paramount, more below. We like active investment amid today's signs that this may be the best time for fundamental stock pickers for a host of reasons. Ooh, they're suggesting they like people who look for companies with big PP, big pricing power. Okay, interesting. Reasons why. Resources and eyeballs allocated to active fundamental investing has shifted from passive or private equity, arguing for less efficient market that is basically higher alpha. In other words, in English, like there's an opportunity today to pick stocks that there hasn't been in the past. Okay, good. Then we have, let's see here, mean reversion evaluations, fine. 46% of large cap active funds are ahead year to date, a 5-year high. Assets under management in ETFs is now at a critical mass. Client data shows that the tide may be turning. For most of this year, investors have sold ETFs and bought single stocks. Finally, breadth is indicating a mean reversion for more ETF buying, basically. Wow, interesting. Okay. So what else here? This is about index or cap weighted. Okay, here. If equity sentiment is bearish, why then is the S&P 500 doing well? Well, if Wall Street is dominated by buyers, remember the line I said, there are no sellers. Like, who's really selling Tesla? The only reason you'd really sell Tesla right now, because I do think there still are legs, or if you're rebalancing a little bit, or you have to, like some funds have to rebalance a little bit because there are various different compliance rules and laws that say, hey, like if a certain thing has happened, we have to rebalance. Certain sectors can't be too overweight or whatever. But beyond that, like who's really betting against Nvidia right now? As another example, well, it's hard to bet against it. That's why it's only 1% short. But anyway, it's people don't want to sell these things right now because we don't know. But anyway, bonds and cash have been favored over stocks, but there are a lack of sellers. Because there are a lack of sellers, you're seeing more of these price increases. But what happens then when you actually get real inflows into these? Now that'll be quite interesting, and that's roughly what they're prepping for right here. Can I make money off AI? Heck yeah, you can. Obviously, the benefit are companies that provide AI services. We already talked about that, so that's a little redundant. So they give a little bit of some projections over here by 2026. They think the AI total or the AI software market, wow, will represent this item here. And then you've got AI services as a smaller segment, AI hardware as a small segment. Wow, they really see software spend as being the highest. Now, I agree with that. I just don't know which companies are going to be the beneficiaries of that at this point. It's a little too early to tell. Okay, so you could see here's a bear that's flip-flopped, but we have another piece that we have to talk about. Let's look at this one. This one just came out today, actually, and it's called the Bear of Little Brain. Ooh. All right, so what is it? So scores on the doors, crypto 36%, stocks 13%. Well, that's the S&P, it must be, and that must be BTC. What is it? Or I don't know what it is. Yeah, these are year-to-date returns. Okay, fine. Me, I'm never wrong. Wife, you should explore that. My experience of you is you're always wrong. Biggest picture. Cyclical breakouts of non-US stocks versus global fixed income. All right, let's get to where they actually get away from their summary and they get into some actual talk here. Some English is what we want to see. All right, here we go. Ready for this? So first thing I always like doing is I like looking at this bull bear indicator. So right now you've moved off of the extreme bearishness scale, but notice we're actually not at the extreme bullishness side. And this is what I've been talking about, this idea that, yeah, it may feel like, the stock market has been rallying so much, but it's because of a lack of sellers, not because everybody is piling on. So I agree with this chart. And if it were different, obviously I would say so. I'm not trying to just use this as a way of reiterating my opinion, but I would agree with where this is. I don't think we're extremely bearish right now where people are dumping. But people have stopped dumping, and there's a lack of dumping. There's no dumping happening anymore. That is just any incremental buying is leading to prices going up. So what do we have here? Bears like us have been wrong in the first half of 2023 because, okay, so in other words, bears like us have been wrong. I love that line. It's just music to my ears. But then you have to be careful because as soon as the bears become bulls, does that mean it's time for the bulls to become bears? Oh no. Okay, anyway, Goldilocks trumped recession. Neither the Q1 EPS recession or the first half recession happened. Actually, that would be the second half recession. Nominal GDP remained supercharged by fiscal stimulus. That would be like the CHIPS Act, your Inflation Causation Act or Reduction Act, depends on what side of the aisle you are on. Labor market impervious to monetary policy in the post-pandemic world. So far, pretty true. Interesting comparison after the Spanish flu, chart 8. Oh, I want to look at that. I want to see a comparison, chart 8. Here it is. Spanish, no way. Look at that. That's so cool. 1920s. Sorry, this is not the Spanish flu. When was the Spanish flu? Was it 1920? Oh, whenever the Spanish flu. Yeah, it was over here, like 1919 or something like that. Wasn't it? I'm pretty sure it was. But anyway, the 20 Spanish flu era was also impervious to monetary policy. Oh, that's interesting. Let me see what date was this. Yeah, 1920s after the Spanish flu. Okay, chart 8. What are they showing here? Because there's a little bit of a bump here in the US unemployment rate. Let's see here. Let's do this. When was the Spanish flu? Let's find out. So we can February 1918. Okay, yeah, 1918 and 1919. Okay, well that's what I thought. All right. Well, that's interesting because you did get a little bit of a bump here in the unemployment rate. I suppose maybe not as high as expected. Okay, fascinating. Anyway, no credit crunch. The regional banking crisis threatened a credit crunch, but was averted thanks to the Fed's by the Fed Pivot Facility. It's actually the Bank Term Funding Program, but anyway, no QT, no liquidity drain. Quite the opposite. We basically added money to the markets, which, as we've seen, AI bull run. Unanticipated event in the first half was the AI run, which caused basically this magnificent incline of 7 stocks rising and driving up the S&P. So basically, the bears are like, hey, we weren't wrong because of our opinions were wrong. These crazy things just happened. Like, oh my gosh, we didn't go into a recession and we didn't have an earnings recession. So in other words, you were wrong. There was no credit crunch. And AI is why we were wrong. It's actually a little bit of a cop out, I have to say. Now, this is still bearish right here. We see a max 100 to 150 point upside versus 300 point downside. This is for the S&P 500 between now and Labor Day, which is in September. We are not convinced we are at the start of a brand new shiny bull run. This person sounds salty. We're not convinced we're at the start of a new shiny bull market. This still feels more like a combination of 2000 and 2008, a big rally before a big collapse. But until the Fed reintroduces fear via the terminal rate going to 6% to crack embedded inflation, core CPI around 5%, Treasury yields over 4%, a signal of financial conditions tightening, and then unemployment over 4% signaling a recession, we can still end up having equities elevated. Maybe this could be true, right? I mean, if the Fed does end up wanting to go to 6% and real rates stay high, maybe. But the big thing for me that keeps me bullish right now is that break-evens chart. Now we'll have consumer sentiment data that we'll be paying close attention to, but so far expectations for inflation are staying relatively low and anchored, and that's good. You see a breakout of expectations, that's your sell signal. No landing plays, limited trading upside. Okay, limited trading upsides because the Magnificent Seven have already run so much, is what they're arguing. That's what they're arguing. Okay, cool. So semiconductors say no landing, but PMI says otherwise. Yeah, this is another bear argument people are using. The Purchasers Managers Index, ISMs, which are right here in the negative contractionary territory, while semiconductors are skyrocketing because of AI and chips. Yeah, you are seeing some form of recessionary environment for manufacturing. Certainly even freight, and a lot of that makes sense. A lot of companies have spent a lot of money on CapEx and have over allocated, and now there's a limit to how much more they can spend on CapEx, with the exception of AI style CapEx. What do we have here? Consumer savings are only 4.1%. That's true, but if you actually zoom into this, consumer savings have started rising again, and consumers still have excess savings. So yes, while that is bearish, it started actually ironically rising again, which is remarkable. Now, of course, they wouldn't want to show it rising again because it's much, better for their argument to go all the way back to, I don't know, 100 years ago. That's all right. Same store sales suggest weakening. Yeah, I do think that staples and store-based consumer discretionaries, the Targets, the Best Buys, and that may have some pain coming. I actually think internet discretionary like the Etsy is undervalued right now. but we'll see. After July, year-over-year comps for inflation get tougher. That's true, but that means we still have one really good report ahead of us potentially. And those are for year-over-year numbers, not month-over-month. Fed credibility on the ropes again. Well, duh. That's why I don't think they're going to start raising rates again because it affects their credibility even more. Magnificent Seven bubble. Magnificent Seven market cap as a percentage of the S&P. This is basically showing you that the biggest stocks in the S&P 500 are the biggest allocation of the S&P 500 again at 28.2% again, compared to the highs of 28.9% in 2021 and the lows of 20.1% in 2022. So outflows from cash in the last 8 weeks, money market outflows. This doesn't look. Here's the 4-week moving average. You actually still have let's see here. Money market flows, positive versus negative. Yeah, okay. First, what do we have here? First outflow from cash in 8 weeks. Okay. So what this is saying is the average flows for money markets right now are still in. That's the dark blue line. That's your 4-week moving average. People are still putting money into money markets. Anytime this number is or the bar is above this line, it's an inflow into money markets. It's going into cash. But we have our first outflow in 8 weeks here again. And I would be surprised if that money these outflows we're seeing are going into equities. Wouldn't shock me at all. All right, what else here? Some more charts. You can kind of pause on some of these. Some of these are a little boring. I went through them a little earlier. Bull bear indicator. All right, what do we have here? Hedge fund positioning, neutral. You've got equity flows, very bullish. Equity market breadth, bullish. Bond flows, neutral. Okay, whatever. Bank of America, bull bear indicator. Oh, look at that. See, even though this guy's a bear, you could see that we're not sitting at these euphoric levels of what you saw at the end of 2021. So this is why I still think this rally does have legs. And they just compare winners and losers over here. That's fine. So it's interesting to me. It's sort of a summary of these two things. You have two bears. You have one that flip-flopped away from being a bear and is like, yeah, no, this rally has legs. There are just too many. There's too much money on the sidelines. There are too many marginal buyers still available. And, people are hoarding too much cash, basically. That's on one hand an issue. And then, so you have this bear flipping bullish. And then even the bear is kind of like struggling to find an excuse for why they were wrong. But then rather than doubling down on talk of the earnings recession, they're like, well, the Magnificent Seven are overvalued. Well, then is the market bearish right now? No, it's just slightly above bearish, but it's not extremely bullish. So it's like the bear's own arguments aren't really feeding into a reason to be even more bearish here. They do give us a warning that, well, you're going to have higher inflation comps after June, and maybe that earnings recession will come, but he barely mentions that and suggests maybe there's a 300-point downside for the S&P 500 between now and Labor Day. But what's 300 points? 300 points out of where the S&P sits right now is like maybe a 7% downside. And he suggests maybe there's a 2% upside. So I guess we'll have to see. But, I personally think the more bearish people end up getting on bonds by an opportunity cost, the more people are going to dump their bonds, ironically keeping yields higher. And then when they keep yields higher, they're just going to drive people into stocks because the value of the bonds will go down. That's why yields go higher, because the value of their bonds goes down. Sure, it's nice to farm that yield, but again, if you're farming 4 or 5%, but then you're seeing, stocks do that in a week, it's a little bit of a pisser. So anyway, that gives us a little bit of a look into what the bears are saying. Reminder that we have a price increase tonight on the courses on building your wealth, and we're releasing a lot of new courses, or course lectures rather, not new courses, new course lectures for the existing courses at the end of our 4-phase increase. So buckle up for that. So we have to go to the course member live stream here. I'm just going to look at some comments here. Does the fear and greed index support the change in sentiment? Well, I think what happens, what you could see is you could start seeing an early inflection of a change in sentiment, because what you're doing is you're moving off of the super bearish environment. And that's a change. That's an inflection point, right? So as sentiment changes from everybody's a super bear to okay, less people are becoming bears or staying bears and more people are starting to flip-flop. Well, that's an early indicator of you moving away and seeing a sentiment change. It's not saying that everybody is bullish. That's different. So, but good question. No, I like that question. So what else? Let's see here. I'm looking to buy some bonds and silver. Stocks seem very expensive right now. Max, I was looking on the IGs and the Twitter DMs. I didn't see you, man. So you have to bump that one. But yeah, I mean some stocks are starting to look pricey again, right? Let me post the course member live link really quick, and then I'll answer one more question here, and then we'll jump on over to the course member live, which would be very fun. So stand by for the course member live. I know I'm putting the Discord there. Okay, need to make more coffee. See y'all there. Yep, we'll see you in the course member live. All right, any last minute question here? Kevin, do you think Tesla has more room to run in the short term? I actually do. Yeah, I mean, I think the euphoric levels will come, but I don't think we're there yet. So we'll leave it at that. I've got to run, and I'm going to go right into course member live. We'll see you there. Bye.